Sydney's auction clearance rate has collapsed to 51%. Half of all properties failed to sell last weekend. An entire postcode.
If you're trying to buy in Sydney, this one's for you. Stick around. Here's what nobody is telling you about Sydney's apartment market in 2026. There is no single Sydney property market anymore. There are two. One is rising. The other is collapsing in slow motion. And the suburbs that look like the safest bet on paper, the new towers, the transport hubs, the government-backed first home buyer zones, are the exact suburbs the data says to walk away from. Tonight, we are going to do three things. First, we are going to look at the fragmentation, why a postcode in Western Sydney can rise 37% in a year, while a premium suburb in the east falls for 5 months straight. Second, we are going to name the oversupply postcodes, the specific suburbs where buyers, agents, lenders, and bank valuers are quietly pulling back. And third, we are going to show you the policy trap, how a federal government scheme launched in January is pushing first home buyers directly into the suburbs. The smart money is leaving. Welcome to Sydney Housing Collapse. And before we go further, you need to hear this one number. According to Cotality, the gross rental yield on a Sydney apartment in 2026 is 3.0%, the lowest of any capital city in Australia. Let's sit with that number for a moment. Cotality data. January 2026, gross rental yield on a Sydney apartment, 3.0%. Gross. Before strata. Before council rates. Before maintenance. Before the lift breaks down in your tower and the special levy lands in your inbox. 3.0% gross means that after costs, a Sydney apartment investor is typically clearing somewhere between 0 and 1.5% on their money. You can get 4.3% in a high-interest savings account at any major bank in Australia right now, government guaranteed, with no tenants and no toilet to fix at midnight. Translate that into a real person's life. Take Daniel, a 34-year-old paramedic who bought a 2-bedroom apartment in Zetland in 2022. He paid $890,000. His mortgage repayments are now $4,600 a month. His rent comes in at $3,200. Strata is $1,800 a quarter. Council and water another $400. Daniel is losing approximately $1,800 every single month on a property that, according to his last valuation, is worth $32,000 less than what he paid for it. His exact words to me: "I bought what they told me was a blue-chip suburb. I am trapped." Daniel is not unusual. Daniel is the median. This is market analysis only, not financial advice. Always speak to a qualified professional before making any property decisions. So here is the question. If the yields are this low, and the values are falling, and the supply is still climbing, why is Western Sydney rising at the same time? Section 1. The fragmentation. According to Cotality, in April 2026, Sydney house values fell 0.7% for the month and 1.4% for the quarter. The top quartile of the Sydney market, the most expensive 25% of homes, has now declined for 5 consecutive months. Cotality's head of research, Tim Lawless, puts it plainly. He says, the falls coincide with, and these are his words, declining clearance rates and rising stock, giving buyers more options and less urgency at the negotiating table. In plain language, the premium end of Sydney has run out of buyers willing to chase it. But look at the other end. According to Australian property experts, April 2026 data, South Wentworthville, in Western Sydney, has risen 37.2% in the last 12 months. Units in Kingswood, 24.4%. Institutional investor activity in these corridors has climbed 64% from its early 2023 low. So you have premium suburbs falling, outer ring suburbs surging, and in the middle, the high-density apartment zones flat, fragmented, and starting to slide. Meet Priya, 31 years old, software engineer, renting in Marrickville. She has $85,000 saved. She has been outbid 4 times this year, every time by a buyer from a major city in India or China, paying cash for properties in Schofields, Kellyville, and Box Hill. Her quote, "I am not competing with other first home buyers anymore. I am competing with someone's investment portfolio." Now the counter-argument. Plenty of agents will tell you the Western Sydney boom is the new normal, that infrastructure spending, the Western Sydney Airport, and population growth justify the prices. And there is truth in that. The infrastructure is real. The population growth is real. But here is what the data says. Cotality's April 2026 figures show the bottom quartile of the Sydney market up 1.8%, while the top quartile is down 2.4%. That is not a boom. That is a rotation. Money is not arriving in Sydney. Money is moving within Sydney out of the expensive postcodes and into the cheap ones. When the rotation finishes, there is no second wave behind it. The boom is a redistribution. It is not new wealth. Section 2. The oversupply postcodes. According to ANZ Research, April 2026, the high-density precincts that experts are now actively recommending against investing in are Parramatta, Homebush, and Zetland. According to Buyer's Domain 2026, that list expands to include Green Square and Wentworth Point, all facing what their analysts describe as periods of oversupply and slower capital growth in high-density developments. Let's translate. Oversupply means the building never stops. Slower capital growth means your apartment is worth less in real terms every single year you hold it. And it means when you try to sell, you are not competing with 3 other listings on your street. You are competing with 30. Meet Marcus, 41 years old. Bought an off-the-plan apartment in Green Square in 2021. Settled in 2023. Listed for sale in February 2026. 6 months on the market. 2 offers, both below what he paid. His words, "Every time I think the market has bottomed, another tower opens up across the road, and we start again." And Marcus is not alone in the building. He told me there are currently 14 apartments for sale in his complex of 212 units. That is a 7% listings rate in one building. The Sydney-wide average is around 2.5%. Now, the counter-argument. Developers, agents, and some buyers' advocates will tell you that long-term, every Sydney suburb appreciates. They will point to 20-year charts. They will say if you just hold, you will be fine. But here is what the data says. According to MCP Financial and APRA, lenders in 2026 are now formally evaluating postcode concentration in high-density corridors. Locations identified as oversupplied are attracting more restrictive loan-to-value ratios. Large tower buildings are facing valuation obstacles. In plain English, the banks themselves no longer believe the 20-year story for these specific postcodes. They are pricing the risk in today. When the bank's own valuer marks your apartment down, the chart on the wall does not save you. Section 3. The policy trap. According to Buyer's Domain, reporting on Labour's housing policy, since January 2026, all first home buyers in Australia can purchase a property with only a 5% deposit. No income cap. The federal government guarantees up to 15% of the loan. On paper, this sounds like help. A first home buyer who would have needed $85,000 saved for a $450,000 apartment now needs only $22,500. The door opens. But translated, a 5% deposit means a 95% mortgage. It means almost no equity buffer. It means if your apartment falls 5% in value, which is exactly what SQM Research is forecasting for Sydney in 2026, you are in negative equity from day one. And the suburbs, where the apartments are cheap enough to be in scheme range, are, and you can see this coming, Parramatta, Homebush, Zetland, Green Square, and Wentworth Point. The same suburbs ANZ Research is telling investors to avoid. The scheme is not financing first homes. It is financing the absorption of oversupply. Meet Aisha, 27 years old, primary school teacher in Penrith. approved under the 5% scheme in February 2026. Bought a one-bedroom apartment in Homebush for $540,000. Her quote, "The mortgage broker said it was safe because the government was guaranteeing it. Nobody mentioned that the government guaranteeing the loan does not guarantee the price." Now the counter-argument. Supporters of the scheme, and there are serious economists among them, argue that without it, an entire generation locks out permanently. They argue that some path into the market is better than none. It is a fair argument, and it has one fatal data point against it. According to SQM Research and Macro Business, March 2026, Sydney prices are forecast to fall between 2 and 6% in 2026. If the Reserve Bank cash rate climbs to 4.85%, that falls expand to between 5 and 9%. SQM founder Louis Christopher described the current market in a single sentence: "Fear is dominating the market, with buyers actively withdrawing." If the price falls 9% and your deposit was 5%, you do not have a home, you have a debt with walls. It is not the deposit that traps you. It is not the mortgage that traps you. It is buying the wrong postcode with borrowed time. So how does Sydney compare? Let's look at Melbourne and Vancouver. Same metric in each city: gross rental yield on a median apartment in 2026. According to Cotality January 2026, Sydney sits at 3.0% gross. Melbourne, the same Cotality dataset, runs at approximately 4.1%, over a full percentage point higher on the same metric. Translate that to $1 million apartment. $11,000 additional dollars a year of gross rental income for the same purchase price, in the same country, under the same tax law. Now Vancouver. According to Demographia's 2026 International Housing Affordability Report, Vancouver's median multiple house price divided by median household income sits at 12.3. Sydney sits at 13.8. Two of the three least affordable major housing markets in the developed English-speaking world are on opposite sides of the Pacific Ocean. But there is one difference. Vancouver implemented a foreign buyer tax in 2016, a vacant homes tax in 2017, and a speculation tax that now sits at 3% for non-residents. Sydney has none of these at meaningful scale, and Auckland, once one of the most expensive cities in the OECD, has now fallen for 33 consecutive months from its 2021 peak, a cumulative decline of approximately 18%, according to CoreLogic NZ data. The trigger was a combination of rising rates, foreign buyer restrictions, and supply, finally catching demand. Sydney has the rate rises. Sydney does not have the restrictions. And Sydney's supply, the apartment supply, is now arriving in the wrong postcodes at the wrong moment. The pattern is global. The specifics are Sydney's alone. 3 scenarios for Sydney apartments through the end of 2027. Best case. The Reserve Bank holds the cash rate. The federal government adjusts the 5% deposit scheme to exclude oversupplied postcodes, and Cotality's forecast lower bound holds. In that scenario, Sydney apartment values fall around 2% in 2026, flatten in 2027, and oversupplied postcodes underperform the broader market by another 3 to 5%. Even in the best case, anyone who bought an apartment in Green Square, Zetland, or Homebush in the last 2 years is sitting on a loss for the rest of the decade. Best case is still painful. Realistic case. The Reserve Bank holds through mid-2026, then cuts once or twice late in the year. The 5% scheme continues unchanged, absorbing first home buyers into the high-density postcodes. Cotality and SQM Research's central forecast plays out. Sydney apartment values fall 4 to 5% in 2026, with the oversupplied postcodes falling closer to 8 or 9. Approvals from 2026 that 49.2% year-on-year surge begin delivering completed stock to the market in 2028, just as the policy-driven demand is exhausted. Owners in Parramatta, Wentworth Point, Green Square, Homebush, and Zetland enter what Tim Lawless of Cotality calls a structural buyer's market. Buyers have stock, time, and options. Sellers have none of those things. This is the scenario the data points to. Worst case. The Reserve Bank raises the cash rate to 4.85% to control sticky inflation. SQM Research's upper bound forecast plays out. Sydney apartment values fall 9% across the board, and 12 to 15% in the oversupplied corridors. First home buyers under the 5% scheme enter negative equity en masse. Banks tighten loan-to-value ratios further on high-density postcodes. The market does not crash, it freezes. And a frozen market in a falling city is worse than a crash, because you cannot exit. If you are a current mortgage holder in Sydney with an apartment in Parramatta, Homebush, Zetland, Green Square, or Wentworth Point, get a current bank valuation before the end of this quarter. Not an agent appraisal. A bank valuation. You need to know your real loan-to-value ratio now, not when you try to refinance and find out the hard way. If you are a first home buyer considering the 5% deposit scheme, read the postcode before you read the marketing. The same suburbs where the scheme makes apartments affordable are the suburbs ANZ Research is warning investors away from. Cheap and safe are not the same word. If you are renting in Sydney, the 3% gross yield is your leverage. Landlords in oversupplied buildings are losing money every month. In 2026, you have negotiating power on rent that you have not had since 2019. Use it. If you are an investor, Sydney apartments at 3% gross yield, in a falling market, with tightening lender rules on high-density postcodes, are no longer an investment. They are a position. Know what you are holding. 3 numbers to take with you. Sydney auction clearance rate 51%, the lowest in years. Sydney apartment gross rental yield 3%, the lowest of any Australian capital. And SQM Research's forecast, Sydney prices falling between 2 and 9% in 2026, depending on what the Reserve Bank decides next. The data does not say every Sydney suburb is failing. It says some suburbs are rising on a rotation that ends, and others are sliding on an oversupply that is still being built. And a federal scheme designed to help first home buyers is quietly pushing them into the exact postcodes the lenders, the analysts, and the institutional money are walking away from. Sydney does not have one housing market. It has 2. And the door the government opened leads into the wrong one. Subscribe to Sydney Housing Collapse new analysis every week. No agents, no spin, just the data.